Good morning, ladies and gentlemen. Welcome to the next in the set of webinars that HR Talk are presenting. Today, we're going to be chatting about the tax obligations of individual taxpayers for the 2020 tax filing season. You are lucky enough to have two people presenting today. Today, I am the first officer. I will be starting, and your pilot today is Aaron Sneyman from our Hilton tax office. Just a little bit about myself. I've been in the industry for more than 25 years, mainly in the employees tax space, but I've got a lot of experience in COID, UIF, pretty good income tax experience from my SARS days. But as I always say, you're always learning when you're dealing with income tax. The pilot, as I said, is Aaron Sneyman from our Hilton office. Aaron looks after all the tax returns and the provisional tax returns. She's also got extensive experience in UK tax. So those of you who have issues or are dealing with jurisdictional issues between South Africa and the UK, you would chat to Aaron. But today we're going to start with a little bit of the seminar that I covered last week, and we're going to start with the phases, the tax filing of the tax filing season for individuals. We're going to have a quick look at auto assessments. In fact, we're going to have a slightly longer look at auto assessments in this webinar. We're going to then briefly touch on tax issues when you decide to tackle your tax return, particularly the bigger issues that make assessing the return and getting your money from SARS more complicated. Aaron's an expert in that space. We'll probably both chat about that and answer questions at the end. And then Aaron is going to be talking provisional tax. Those people who are provisional taxpayers will know your first return for 2021 is due at the end of this month. Aaron's going to be chatting to you about who qualifies as a provisional taxpayer, what is provisional tax, and how you do calculations. Basically, what not to do and what to do to avoid penalties. So let's just look at the phases introduced for the 2020 tax filing season. As I mentioned last week, the traditional 1 July starting date for tax filing season appears to be a thing of the past. I've got my concerns as to why this has changed, but those of you who read the paper or any online articles on tax would have heard SARS PR effort at explaining why the tax filing season has moved. So what I would like to do is just explain to you the flow in terms of where does your documentation come from? How does it get to SARS? And then obviously how the tax return happens. Now, obviously the first phase is the phase of the employer and your third parties actually ensuring that the data that they've got for the period under review, which in this case is 1 March 2019 to 29 February 2020, is correct. They will do various testing. They will look at the integrity of their data to ensure it's right. And then on the 15th of April, SARS will open their systems to allow the uploading of IP5s and your MP501 reconciliations. So that first phase, as I said, is just tidying up and submitting this third-party documentation. No real changes or no significant changes. Then phase 2, you've got this cleaning up. Okay, so basically, a lot of taxpayers do not keep accurate information with SARS, and that causes huge problems to SARS. So SARS want to make sure that to facilitate this uploading of third-party data, that your information is right. We have problems with passport numbers, ID numbers. You'd be surprised how many people's ID numbers at SARS don't match the ID numbers on IP5s. SARS have your old ID number with the last 3 digits different to the new one. So that would be a reason why, or potentially why, an IP5 may not be pulled through. So this is a tidying up phase, and all these corrections will be made. SARS will then issue what they call these auto assessments. Now, it was an absolute disaster this year. We have seen auto assessments before, so auto assessments are not new to filing season. Aaron can vouch for me. We've had it in previous years. Your very simple tax returns, the auto assessment process has been successfully used. This year, it appears as if there's been this massive flood of information that SARS have released on to allow people to do these auto assessments. Now, a lot of the auto assessments that I've seen are wrong. And the reason that they're wrong is because SARS have assumed in a lot of cases that employees with the travel allowance are not going to claim. Now, obviously, if you've got a travel allowance, you'd be very silly not to claim, because then you wouldn't qualify for a tax deduction and you would owe SARS money. So imagine you are the taxpayer and you get this SMS sent to your phone and it says you owe 15,000. Aaron will vouch for me. We received a flood of phone calls and hysterical emails about, why do I owe SARS money? Now, from a payroll space, very, very problematic in that our company, HR Talk, got hundreds of emails saying, what are you doing to our employees? They owe money. Do you not know how to deduct tax properly? And we've had to obviously systematically go through that and say to people, whoa, wait. The auto assessment is SARS assuming that everything is being submitted by a third party. And the types of errors that I've found when I've logged into the client's profile is a missing medical aid tax certificate. Now, that alone can mean thousands of rands of tax difference. RAs that have been missing. As I said to you, travel allowances. You should never auto-assess someone who's got a travel allowance, because they invariably are going to claim a deduction. So the auto-assessments were very, very challenging. Now, obviously, if you, no, excuse me, I'll cover that a little bit later. I'll cover the nitty-gritty. Phase 3, that was supposed to be from 1st of September to the end of January, and that would be for all the people who actually have to submit a tax return where there are going to be significant changes. So people who have travel allowances, people who have interest that might be from third parties overseas, people who have rental income, any other sort of income where third party data wouldn't go to SARS. That filing season was meant to open on the 1st of September and close for provisional taxpayers on the 29th of January. But what we've seen is we've seen a free-for-all. I was working on the basis that 1st of September was the date that we had to abide by, but I see SARS are assessing returns and paying money. So I've been shouted at by numerous clients about that. So going back to what is the logic of the auto assessment? Now, obviously, COVID-19 complicated things significantly. You'll be shocked to know how many people still go to SARS offices with their documentation and sit there with SARS and do their returns. Obviously, that hasn't been allowed now. And should you wish to visit a SARS office, you have to make an appointment. So that is difficult in that most people have to wait 3 weeks to have an appointment. So what SARS have done is they've said, okay, let's introduce a self-assessment system. Let's also protect ourselves against people potentially not disclosing information. So let's force third parties to submit documentation. And we've seen problems with that. Last year, I had significant problems with SARS SARS actually reassessing taxpayers on the basis that we'd under-declared interest. And they said, well, we've got information that the person earned 75,000, meanwhile they only earned 25,000. And there was a problem with SARS at that point, where SARS was duplicating the current year's interest and then adding the interest for the first 6 months of the following year to the 2019 assessment. So I had 3 of those that obviously were hugely challenging and took up a lot of time. So back to auto assessments. SARS want to make it as easy as possible. They want to make it as quick as possible. And they want to limit the number of people that come into their venues, whether they be COVID or not. SARS must be a place to go to solve a problem, not to do a tax return. So they talk about the seamless filing season. Well, it hasn't been seamless yet. Well, I haven't seen any evidence that it's seamless yet, or it's going to be seamless. But remembering this is the first year of this flood of auto assessments, I think SARS will learn, and hopefully there will be improvement. So they talk about the enhancements of service to taxpayers and to improve their tax filing experience. As I said, that is not applicable in our case because we haven't seen that yet. It's complicated. It's caused stress for the employee, the taxpayer, and it's caused stress for us, the practitioner. So what is the auto assessment? It's effectively a tax return that SARS has completed with all the third-party information that they received. So your RP5s, your RT3Bs, which is interest you earn from the bank, your medical scheme tax certificates, your retirement annuity tax certificate. Now, in an ideal world, that's awesome. And I have seen some very, very efficient tax returns because all the information is there. But that doesn't mean that you take what SARS sends you as gospel and accept it. SARS have published that they've sent out 3.1 million SMSs to taxpayers who can automatically be assessed. I'm not quite sure how many of those were legitimate and how many are problematic. I'm not sure whether we will hear, but I will pose that question to the payroll authors group. So SARS is saying that auto-assessed taxpayers will receive SMSs by the end of August, okay, if they qualify. Now, I suspect auto-assessment SMSs are all out. If you haven't received one by now, you're not going to be able to auto-assess. And then the last point on that slide, I've actually just included an example of the SMS or that you would basically get. And as you can see in this case, the taxpayer was told that they owe 20,189. She lost her mind and didn't stop shouting at me for about 5 minutes before I told her that it was wrong. So probably could have been done better, probably could have been worded better, but I'm sure it will be better next year. So once you've been auto-assessed, you've got 2 options. You accept, and don't just press accept. You need to go and actually look at the return, and you need to check it. But if it's all there, you can literally press accept, and you will be assessed, and you will not have a review from SARS. So awesome. If you owe money, then obviously you have to look at that assessment and look at the second date and make sure that you pay your liability by that date. If you disagree with the auto assessment, then you will edit it. So you will need to go through it and check and add potential additional information. In the case of a travel allowance, you will obviously include opening and closing mileage, the cost of your vehicle, the dates you've used your vehicle, and the split between business and private mileage. In the case of the 20,000 lady, her situation swung around to an 18,000 refund. So you can see how problematic the publication of the auto assessment SMSs can be. So what should the taxpayer look for? Each taxpayer needs to validate their auto-prepared tax return. So you cannot assume that SARS is everything. You need to collect all the paperwork that you normally collect to do your tax return. And then you do a tick box process. Do they have my RP5? Tick. Do they have my RAs, my medical aid, my interest? Now, in terms of interest, Erin will probably also agree with this. Often taxpayers have got no clue about the sources of some of their interest. So submitting a tax return and then getting a reassessment with SARS dredging 15 grand's worth of interest out of somewhere. As the practitioner, you have to then request a reason from SARS and a source. And then you make sure that obviously next year you make sure the client gets an RT3B from there. But with this process now, anyone who's paying interest is obliged to send that RT3B. So it's quite interesting to see the number of sources of interest already on the tax return. If you don't have certificates, request them. If they're not on the tax return automatically, you need to make inquiries with your third-party service provider as to why. I asked the client to do that, and she was shouted at by a medical aid, but who said that they must speak to SARS. But it's important that you make sure that what the third party's got is the same that SARS has got, and it's all right, because otherwise you're never going to get an accurate auto assessment. And also, to add to the tax return, in our experience, you're going to get a query, and that's going to delay the payments of a potential refund. So sort that out for next year. If all's right, then you can submit it. As I said, obviously, if taxpayers have got more complicated details, you would add. I've then attached a screen print of what your tax return would look like. And in this case, you need to look at the middle block. It says you have been auto-assessed. Now, the first step obviously would be to review. If you click review, it brings your assessment up, not your tax return, it brings your assessment. If everything looks fine, you can accept it. So you'll see the next button says continue. So this is asking you obviously what choice you want to make. And in the third slide, I've just shown you accept or edit. So, I mean, it's not complicated. The screens are very, very clear. I just wanted to show you before you went down the road of looking at your own return. If you're going to accept this assessment, once you've opened it, you just literally click accept. If you want to edit it, then it's going to open your tax return and you're going to have to add and submit. There was obviously concern as to if I make changes, when is it going to be assessed? Only after September, but it looks like it's being done immediately. Okay, so the next slide, I've basically covered, you would accept it if you're happy, edit if you're not. Do not automatically accept it because you like the look of the SMS. I've had 2 of those already this week where clients saw 8,000 Rand refund and were thrilled to bits and knew that they weren't going to get queried by SARS and accepted. And they were actually due almost double that. So check it. Any tax practitioner will tell you they're having huge challenges with the auto assessment process because taxpayers think that the tax practitioner does nothing now. A good tax practitioner will not charge you a full fee for the submission of a tax return if you've auto-assessed, but it is fair to charge some sort of a fee for the checking and communication process. Taxpayers, clients sometimes lose track of the fact that bombarding their practitioner with emails and questions is free. So if you are using a tax practitioner, ask them what their charge is to do the auto assessment process and check. Okay, so to finish the section, I've added some frequently asked questions. How long does it take to get a refund? I would normally tell the client how long is a piece of string, because we are dealing with SARS. But SARS confidently say for the majority of the taxpayers, 3 working days. That's provided your banking details are right and they don't drag you through the mud with a review or tell you that your banking details are rejecting. If I didn't receive an auto assessment SMS but see that my return is available on e-filing, should I wait until 1 September to submit my tax return? No, SARS say. You may file now. File now before the money's gone. What is the time frame to accept an auto assessment? We know that the time frame for taxpayers who are working on e-filing is the 16th of November. But what SARS are doing is if you haven't actioned the auto assessment, they will send an estimated assessment after the 29th of January, so after the filing season ends. But I don't see why you shouldn't submit your auto assessment as soon as possible. What does the error message? And I'm going to quote, we could not display your calculation 4482 RP5 LS amount missing. I got 3 of these where clients were very unhappy that we were incompetent and we didn't know how to do RP5s. Sorry, only one person said that to me. But it wasn't even an HR Talk RP5, but this is not a problem. This is a SARS issue, and it's an error message that's coming up for no reason. So SARS are fixing it on their side. There's another one that's also doing its round about a lump sum that is also wrong, particularly when none of those clients have lump sums. So to come to HR Talk and say, look, we've messed up in RP5 because of a lump sum. You didn't receive a lump sum. Did you receive something from a third-party retirement fund? No, I didn't. It's obviously a SARS issue. Next question, can I go to a SARS branch if I have problems with my tax return? No. They will chase you away, and at this point, you are even very unlikely to get an appointment unless it's a major technical issue. If I make changes to my tax return and SARS requests supporting documents, how long does this verification process change? Well, the standard turnaround time is 21 business days, but it depends how busy SARS are, and during COVID times, understaffed, they haven't been as efficient, so please be patient. Okay, so that's the end of my involvement. I will be hanging around to answer some questions later. Erin's now going to take over and chat about a couple of issues relating to the annual tax return.
Thanks, Dave. It's great to have you with us today. I'm just going to go continue straight on from where Dave left off. So let's start by looking at some important matters to focus on when completing your annual tax return. Like Dave touched on, a lot of the time people just take the third-party data that SARS has on the tax return as correct, and it's super important that although SARS is loading the third-party data onto your return, you really need to check the information correctly. So don't just assume it's correct. Have a look at policy numbers, make sure that dependents on your medical aid are all included, and check that everything, the figures are all correct as well. Don't just assume that it is correct. Also, if you were to edit your return and not go the auto assessment route, what will happen is when you open your return, you're going to be presented with a wizard form. And the answers to the questions on the wizard will then determine what sections of the tax return that SARS is going to open up for you to then complete further. SARS also automatically completes part of the wizard form based on third-party information. So again, it's super important to check all those questions and answers very carefully, because if SARS hasn't been sent any third-party data, then obviously the wizard form is going to be incorrect, in which case it follows on and your tax return is going to have missing information, and it may result in you getting reassessed later, and it just delays your whole tax return process. The nice thing about these third-party certificates, I've shown you an example here of an RT3B, is they always show the tax source codes. So if you do get stuck on your tax return, always go back to your actual source document, your RT3B certificate, and have a look at the source codes, because those source codes are on the tax return as well. And so you can just follow on from those. So where you see local interest, it will have the correct, 4201 code, and you can go check, on your tax return, this is where it goes. You can also use it again for checking. So it is important to look back at your source documents as well. So included here, travel. And travel is super important because it's a part of the tax return that always raises red flags with SARS. And so it's important that you complete this section extremely accurately. SARS is clamping down on logbooks. And a lot of the time, what will happen is we'll get a logbook, which was the same as last year, which SARS may have accepted, but this year they're not accepting it. So I suggest that if you do have a logbook, it might be beneficial to go to the SARS website and just get their logbook, which is free. You can download it. It's in PDF format, and it's got all the details. This little snippet here is from SARS's website. A lot of the time, people will have business travel details of from where they're going to where they're going, but they don't have a reason. And SARS is then kicking that out and asking them to redo the logbook and then make a resubmission to them. The other important thing about travel is you have to put in your vehicle cost price. Now, a lot of the time, people will just guesstimate or say, okay, my car is worth X. What SARS wants is original cost that you paid for the vehicle, and they are going to ask for proof of this. So it is super important that you put in the correct amount, because that amount determines the claim that you're going to get back as well. And what I have seen last year countless times is where SARS has requested information for the cost price of the vehicle, and the taxpayer doesn't have it, or it's too far gone for them to find that documentation. So nothing gets uploaded, and SARS comes back with a cost price of naught, which means that you're now not going to get the deduction. So having all the information and documentation prior to doing your tax return is important, because it's just going to make the process that much smoother. If SARS does select you for review, so once you've assessed your tax return, once you've submitted your tax return, on the tax return, you'll see it will say selected for audit or verification, and it will have a yes. You'll also get an SMS and an email, but this is a quick way just to determine if SARS has now reviewed you. What you'll do then is you also have a letter on your e-filing profile. And it's super important to upload this review letter along with all the other supporting documentation. The reason being is on this letter, underneath the details section on the right-hand side, you'll see it says case number. This case number is specific to the review that SARS has requested on your tax return. So by uploading this documentation, is obviously not going to delay the finalization of your return. If you admit it, SARS now has to go back and try to find the case number, and so it does delay things. So just make sure that you are including that. So let's look at provisional tax. There are some nice things that SARS has brought out just on a cash flow perspective, which we'll look at a bit later. But the important thing to remember is provisional tax is not a separate tax from income tax. It forms part of income tax. All it is a method of paying your income tax liability in advance. This is just to help you in terms of cash flow, so you don't get left with this large tax bill when it comes time to submit your tax return. So it spreads the liability over the year. So as a provisional taxpayer, you pay at least 2 amounts in advance. So if we look here, the first payment is due in August, so at the end of this month, and that will cover the 6-month period from March to August. You then have your second provisional tax payment, which is due at the end of the tax year, which will be next year, Feb, and that will cover the second 6 months. If you think that something may have happened and you underestimated and now you need to make a top up, this is an optional return that is submitted to SARS. It's just a payment that's made, and you can top up in September, and then you would then have your actual tax return due at the end of January for a provisional tax payer. So it's 11 months after the tax year. So who is actually going to be a provisional taxpayer? So any person who receives income other than a salary is a provisional taxpayer. So if you have rental property, foreign investments, if you're carrying on a trade, you've got investment income over the exemption amount, then you're going to be required to submit a provisional tax return. So most salary earners are there for non-provisional taxpayers, provided they don't have any other sources of income. And that's because your employer will then deduct the PAYE and pay that directly over to SARS. So it's important to note that if you are receiving exempt income from any investments, it doesn't automatically make you a provisional taxpayer. So if you receive interest of less than 23,800, which is the exemption for the year, if you're under 65, or less than 34,500 if you're over 65, then it doesn't make you provisional taxpayer. So if you're earning above those amounts, then only would you need to submit a provisional tax return. And then if you're using a tax-free savings account, obviously all of that income generated from there is tax-free, so it's not going to spark you to be a provisional taxpayer either. So let's just look at a provisional tax example. So this is quite a basic one that we're going to go through now, and there are so many more aspects to this, that could be factored into it. And of course, we can answer some questions about it if you have any. So if we look at this, so David's 28 years old. He's a provisional taxpayer for the 2021 tax year. He earns a salary of 300,000 Rand per annum, and the PAYE deducted is 48,000. He also has a carpentry business on the side, and his estimated profits are 128,000. And he has some interest that he estimates of about 12,800. He also estimates he's going to make a rental loss because he's got a flat that he lets out. And he contributes 1,400 per month to medical aid. He's the only person on the medical aid scheme. Okay, so let's have a look at, firstly, we would start by saying, okay, what are all the aspects of his income? So we've got salary, the carpentry business, the interest. Now the interest is under the threshold of 23,800, so we exclude the interest up to obviously the 23,800. Anything above that we would have included. And the rental loss, because rental loss is what is termed ring-fenced, it means you can't set it off against your other income. But next year, if you were to make a profit, you can then carry that loss over. So if we have a look, his total income is estimated to be 428,000 Rand for the year, and he's falling into this 31% tax bracket. What we'd do is we'd do the tax calculation using those tax brackets, and then we'd start deducting the rebates. Now, because he's 28 years old, he's only entitled to the primary rebate. We deduct the PAYE that's already been deducted by his employer and paid across to SARS. And then he's entitled to medical aid tax credits. As he's the only dependent, he's entitled to 319 Rand per month. That gives us tax for the year estimated at about 33,000 Rand. And so what happens is we just do a straight divide by 2, and David would then pay SARS 16,615 Rand and 2 cents for his first provisional payments. So now what happens if by January 2021, because now the provisional tax would be due at the end of February, so we're going to start now estimating from September up until February 2021. Obviously, you'd estimate your last month. But let's say that David starts to realize that maybe his carpentry business is not doing so well, and he estimates that his profit's going to drop to 98,000 per annum. He's also realized that his rent, he increased his rent, so now his rental profits are looking to be about 1,200 Rand. Everything else remains the same. So let's see what would happen for your second provisional tax. So again, we do the similar process for your second provisional tax return, and we look at the income that is now due, and of course we include the rental profit, and we've adjusted the carpentry income. Despite the drop in his carpentry income, he still remains in the same tax bracket, so it's a 31%, and we're going to do the similar calculation for the tax that's due. What we then look at is we deduct again all the credits that he's allowed, and we get to tax that is now due, estimated for the year of 24,000. Previously we had estimated around 33,000. We then deduct what he paid for his first provisional tax return, and now he's only due to pay SARS 7,600. If his income remains the same, so let's say we estimated this and we got 100% spot on, when it comes time to submit his tax return by, let's say, Jan the following year, if he waits till the last day, then he will not have any tax to pay on his annual tax return. He's paid it now in advance. If, however, though, let's say in February, his carpentry business, let's say doubles, obviously he's going to fall into a different tax bracket, and then you would need to assess that at the end of February to see if potentially maybe now it's time to do a top-up, and you would then pay a top-up to avoid SARS whacking you with a bunch of interest on underestimation and some penalties. So to prevent people from thumb-sucking these figures, because SARS doesn't just want you to just complete the provisional tax return because you are a provisional taxpayer. They don't just want you to guesstimate, they want you to have proper workings and you've made proper calculations and estimates based on the information that you have. So what they do is they impose very hefty underestimation penalties, and the penalty is levied if your actual taxable income, so that's your total income less your tax deductions, calculated in your final tax return. So if that's more than your estimated income submitted on your second provisional tax return, then you will be liable for penalties. And the penalty is different for taxpayers whose taxable income is more than $1 million, and it's different for those who are less than $1 million. So if your taxable income for the year is under $1 million, then you're at risk for underestimation penalty if on your second provisional tax return, it turns out to be less than 90% of your actual annual taxable income. So if we have a look here, for David, he estimates his taxable income to be 399,000. Now he's under $1 million, so we need to make sure that this is 90% of his actual taxable income on his final return. If he's under that, SARS will impose penalties. And the penalty is going to be 20% of the difference between the normal tax payable on your estimate and the tax on the 80%, on the 90% of your actual taxable income. So it would be the difference on this tax payable amount levied at 20%. So that they would redo the calculation, but they would only calculate the penalty on 90% of your income versus the actual amount that your actual annual taxable income on your tax return. Okay, and that's at 20%. If you are over $1 million, then SARS is going to expect you to be within 80%. Again, similar situation, SARS is going to impose the penalty at 20% if you're not within that percentage. For COVID, what SARS has done is they've trying to alleviate some cash flow problems, but this is only for compliant provisional taxpayers. So if you're not compliant, then you're not going to be allowed to get these alleviations from SARS. What SARS is allowing is for you to defer a portion of the payment of your first and your second provisional tax liability. So they're allowing this without imposing any penalties and any interest for the late payment. So what they're allowing is the first provisional tax payment due will be based on 15% of the estimated total liability. If we go back to David in that first scenario, we had estimated his tax liability to be 33,000. SARS is allowing you to pay 15% of that. While the second provisional tax payment due is going to be based on 65% of the estimated tax liability. So on the second provisional return, you're paying 50%. So by the time you've completed your second provisional tax return, you would have paid 65% of your total estimated tax liability. Now, this is where it's super important that this is a cash flow aid. It doesn't mean that you now don't have to pay that amount. All it's doing is it's allowing you to delay your payment to SARS. You need to have paid 100% of your estimated liability by September, so by that top up. So in this case, it would be by next year, September. If you choose to do the deferral and you go with the 15 and this 50%, you would have paid 65% by Feb next year. You would need to have paid that balance of 35% by September next year. Okay, and again, if you don't make that 35% top up in September, you are going to be whacked with some interest and penalties when it comes time to submitting your assessment. And it is hefty and it's easy to avoid. So it's best to just, go with a deferral if you're needing it to aid you with cash flow, but then of course make up that top up in September. So just keep that on your radar that there is going to be a third payment that you'd need to make for September 2021. And if you are using a tax practitioner, just make sure that you're so aware that there may be charges for them to assist you with that third top up. Great, and that is all we have in terms of that. So if there are questions, Dave's going to assist with answering some questions if there are any questions around auto assessments, completing your annual tax return, or provisional tax. So we're open to those questions now.
Thanks, Erin. I was actually 28 quite a long time ago, and I've got no carpentry skills, so I don't know who you were talking about. One thing I want to add in terms of provisional tax, clients often resent having to pay, obviously, for provisional tax services. And what they don't realize is the balancing act that the consultant has. One thing that Erin didn't mention was the basic assessment, so in that SARS have an assessed figure from a previous year, and they allow you to use that figure in certain cases. So your consultant does a balancing act. Well, a good consultant will give you all the information possible to avoid you paying ridiculous sums of provisional tax upfront, but also will help you understand what is going to be due for the year. And her examples are very, very good from the perspective that what happens in August is very, very different, could be very, very different to what happens in February. Your first provisional is due at the end of August. It's a provision, and your consultant has got decisions to make, and they should be communicating those decisions to you. Obviously, you don't want to get to February and there's a massive amount to pay because you've been foolhardy in the beginning, unless you're one of those people who obviously doesn't want to give money to SARS until the last minute. So your consultant is also there to prevent that 20% penalty being applied. So they work very hard for their money. I'm just going to look at questions, and there's no open questions. So look, guys, you're welcome to contact us. I've included the email address there. Those of you who deal with me regularly, you're welcome to send questions, and we will answer to the best of our ability. Please remember that obviously we do this for a business, as a business, so we can't solve all your problems for free. But if you're looking for a good consultant, Erin is as good as they come, and she's very thorough. So chat to her if you need help with tax returns or provisional tax. As the slide says, thank you for supporting HR Talk Outsourcing, and we will continue to present weekly webinars to keep your mind active and to identify challenges out there. Thank you so much.
We do have a question, Dave. So we've got from Kishore, if one earns interest above the threshold, does that automatically make you a provisional taxpayer?
Do you want to answer, Erin?
Yes, so it would. So what would happen is if you are earning above, so if you're under 65 and you're earning above 23,800, obviously you are not getting taxed on that income, so it's not being taxed at source. And so SARS is wanting you to now prepare a provisional tax return and pay tax on that interest. So it would make you a provisional taxpayer in that instance.
Okay, so it goes back to what Erin originally said. The fact that you're earning income, additional income, doesn't automatically make you a provisional taxpayer. You've got the thresholds for people under 65 and over 65. If you are going to have a taxable element of income after that threshold is deducted, then SARS want their pound of flesh in advance.
Yeah.
And then from Sharon, thank you, Sharon. We're definitely in this together. We've got a little network of people who support each other, obviously, to get through filing season, and Sharon's on that group. Thank you so much, Sharon. So if there's no more questions, that's a wrap. Thank you.
Great, thank you.